Hey everyone, welcome back to the channel, your number one source for income-oriented investing, and it's time for another episode in our monthly series where we go over the entire income landscape on the Canadian stock market. So for my American friends, stay tuned. The American one where I cover the US stock market is coming up shortly. So as usual, let's check out what the markets have done in the last month. It's been fantastic. We're hitting all-time record highs across the board, including the Canadian stock market, which if we look at the S&P TSX Composite Index, you see that it's up 3.4% in the last month. Just for reference, I'm filming this over the weekend on December the 7th. It's S&P 500, the American stock market, same story, up 1.96%. So yeah, the Canadian market doing really well. This is where now these cyclical sectors, especially financials, are starting to shine, and we know that financials is a very big part of the Canadian stock market. The Nasdaq 100 really well is doing really well, also up 2.47% in the last month. So it's just been record breaking across the board. It's a phenomenal month. So let's check out the income landscape. But before, I'd like to thank the sponsor and good friend of the channel, Harvest ETFs, which has announced recently some phenomenal news. They've increased their distributions for 3 ETFs. Their technology covered call ETF, HTA, the leverage one as well, HTAE, and also their US banks Webull ETF as well. You see pretty significant distribution increases across the board here, 7.69% for HTA, over 11% for Webull, and 6.67% increase for HTAE, the leverage version of HTA. So this is fantastic news, everyone. They're going to take effect this month, so the increased payout will happen in January of the new year. And don't forget that this greatly impacts HDIF and HBIE. They're all-in-ones because HTA and Webull are in both ETFs. So although HDIF, HBIE did not declare distribution increases, they still benefit because they're getting more income, right? And from the underlying ETFs, HTA, which is right here, and Webull, which is right here. So my opinion is that there's obviously more of a chance now in the future, I think in a little short future, that HDIF increases their monthly distribution as well. So don't forget that Harvest has some great insights here. If you go on your website, you click on Insights, they have some great articles here. Latest one on the US banks. They have one on the global healthcare as well. We know that they manage, right, HHL, the biggest by far covered call healthcare ETF, which has passed over 1.5 billion. So again, thanks to Harvest for being a good friend and sponsor. Moving on to the income landscape, of course, we're going to start with and continue with the leveraged all-in-one. So HDIF, HBIE for Harvest, right? These are your all-in-ones. HDIF is 100% equity. HBIE is your 60-40 split. Moving on to HYLD, which is pretty much a concentrated version of the S&P 500. No distribution increase or anything like that yet. Still at a solid 14.3 cents a month here. And now the yield is under 12%. That's because of the share price going up and up and up. Even HDIV, it's at about 11, little over 11% now. And same thing, they haven't, they declared just the usual 17.1 cent distribution. So I know many of you asking, where's the HYLD, HDIV distribution increase? Well, I suggest you go back and check out the Q&As with them. Obviously, they're going to, as you've probably seen, they increase them when they can. They always have a 1% cushion as well. That's Hamilton's policy. Moving on to Global X, of course, you have USCL, which is the S&P 500 covered call ETF with 25% leverage. Don't forget, you just change the L to a C to get the non-leveraged version. QQCL for the NASDAQ, all of which I believe are under 12% yield now. That's how much the stock price has risen. And of course, we got a new player in town, RSCC, the first Russell 2000 covered call ETF in Canada, which just declared their first distribution, 21 cents. Actually translates to about 12% yield. Not bad for a non-leverage. Unfortunately, no RSCL yet. Hopefully they come out with that soon. Moving on to CNCL, that's for Canada, right? TSX 60 for the overall Canadian market. And then you have EQCL for the entire world, which is a combination of their index funds to get you stocks all around the world. So no distribution increases for any of the global X ones as of yet. And last but not least, in terms of the leveraged all-in-one diversified funds, you got BMAX, which we know is about 75% stocks, 25% fixed income, doing really, really well as well. This one's under 10%. That's how much it's going up. We know that Brompton tends to be a little bit more conservative with their distributions, but the total return really speaks for itself, I believe now. Yeah, they're still at 11.5 cents a month. So that's it for the leverage ones. Let's check out the non-leverage ones now. Long list to go through now. It's just getting more and more. You got ZWQT, BMO's all in one, under 6% yield here, still at 8.5 cents a month, so no distribution increase here. The yield on this one's actually under 6%, like I just said, so hopefully they'll increase it soon, but we know that BMO has a rinse and repeat strategy, and this one basically holds a combination of many or most, if not all, I think not all, but most BMO covered call ETFs. You have ESPX and ETSX from Evolve. This is the S&P 500 and the TSX 60. No distribution increases here. I have a strong suspicion one might be coming, especially for ESPX, right? It's still at about 15.5 cents. So the yield is what, 7.24? Yeah, I think they'll maybe they could increase it eventually, but nothing yet. Same thing for ETSX, 8.85. Distribution has remained steady at 16 cents a month. You got the JEPI and JEPQ, new players in town here. JP Morgan's first Canadian listed ETFs, and they actually ported their JEPI and JEPQ ones. I find that really funny. So first distribution has been declared at 14 cents for JEPI. It's the first one, so I don't really know if it's the entire month. Is it more than it should be? Translates to about 6.5% yield, which is pretty much on par with the other JEPI in the States. JEPQ a little bit higher. This is 34 cents a month. So this is actually much higher. I think it translates to a yield of what, about 10%, 9 or 10%, something like that. Let's just do the calculation quick here. 34 cents times 12 divided by the stock price of, let's say, 27.63. Wow, that's 14.76% yield. So I'm sadly mistaken. I have a feeling that maybe the first dividend here covers more than 1 month. So we'll keep track of it. We'll see what happens next month. But JEPQ is typically about 10% yield. And you have FEPI, which is obviously a competitor to JEPI. This is the Fidelity S&P 500 covered call ETF, which does a rinse and repeat strategy, 2% out of the money every month. So you're looking at, I believe, about a 6-7% yield. Then the second distribution was a lot more normal than the first one, 2 cents. I don't know what happened with the first one there, but 17.65 cents. 17.65 cents. Yeah, I think that's correct, right? For FEPI. Management fee at 40 basis points, so 5 basis points higher than JEPI. But if you like a rinse and repeat 2% out of the money call every month, this might be a good option for you for your S&P here. Speaking of S&P, we got an equal weight one. This is the only equal weight one I believe there is from Invesco, EQLI. And it seems to me like this one's having very consistent distributions. I think it's about, sorry, my throat. Sorry about that. I think it's about 7% yield, something like that. And they have QQCI, which is the NASDAQ 100, right? Invesco are the guys who manage QQQ. So obviously it made sense for them to go for QQCI. This one yield is about 9-10%, a little bit more because it's a NASDAQ. And just for fun, I just compared QQCI to QQCC, and QQCC is still outperforming it, which I find very surprising because it has a much, much lower fee than QQCC, but good on Global X. But we'll have to, of course, keep following it. So there you have it, another NASDAQ non-leveraged covered call ETF. So QQCC actually has some competition now. Last but not least, you have the Purpose Enhanced Dividend Fund. This is PDIV, which I'm always surprised with no leverage, how it maintains just under 12% yield, 65 management fee. So the cool thing about this one is that there's Canada and US in here. So this could be a consideration if you're maybe looking to squeeze out more income and you like the fact that you have Canada and US in here and there's no leverage here as well. Split fund guys, there's a lot of opportunity here. So the markets are at all-time highs. We got to find the opportunity where we could find them. And split funds are actually pretty good opportunity because a lot of them are trading at discounts right now, including some that almost never trade at discounts. I mean, DGS 727, but it's worth 739. That's at a discount. Even ESP, which is one I never cover, which is higher risk because it's only energy. It's not trading at a discount, but it restarted its dividend. You got GDV on par. 12.12 here. You have LBS that's trading at a discount. You see the NAV at 1032, but it's worth not. You could pick it up, sorry, for 962. LCS still at a discount. The life insurance companies 1055. You could pick it up. It's worth 11.25 cents a share. PWI just increased their distribution because it's doing so well. You could pick some up for 1043 and it's actually worth 11.06. SBC, the 6 banks, right? You could pick some up for 1054 when it's worth 11.15. So don't be shy to start trying out split funds maybe if you understand them, especially if you could buy them at discounts because that's always great. Even middle field, right? You have ENS, which is Enbridge. Look at this net asset value, $16 NAV, and you could pick up some shares at $14.31. So if you're an Enbridge fan, this is a great opportunity to pick up some ENS. RS, the one that I love and that I hold, which is real estate, not trading at a discount, but close. It's worth 11, and the unit NAV is $21. I mean, middle field never missed a dividend, right? You got $26 of unit NAV here for ENS, $21 of unit NAV for Real Estate Split Corp, and then you have $27.50 of unit NAV for their latest one, infrastructure dividend split corp. So ENS and IS trading at big discounts. RS no discount, but the premium is really small. So that's the middle field ones. Even DFN, I mean, you could pick some up at 645 when the unit NAV is about 681. FTN you could pick some up at 980, and it's worth, the NAV is approximately 1078. So great opportunities, but make sure you understand split funds, my friends, before you invest in them. But remember that you're always investing in that portfolio of stock. Moving on to Bitcoin, which obviously is making headlines, right? Because it's going up and up and up. It crossed 100,000. Now I think it's a bit under that now, but you're looking at 10.5 to 11% yield on BTCY now. So of course BTCY.B is the non-hedged version. All right, I just took out my face just to make sure you guys could see everything. So yeah, massive distribution increase here from 5.25 cents to 8.5 cents. This is for the hedge version. BTCY for BTCY.B, it's a little bit higher than that, but the NAV is a lot higher because obviously it's non-hedged. So Canadian dollar has been doing crappy. So obviously the .B one is beating the hedged one, right? Is beating BTCY. But that trend could reverse, by the way, the Canadian dollar starts going up. But either way, fantastic news for everyone, including myself, that we own BTCY. Even ETHY, I guess I should have held on to it a little sooner before selling it off. But oh well, that's just how it goes. Also doing phenomenal. I mean, look at Ethereum just ripping upwards. And even ETHY and ETHY.B, big increases, distribution increases. Definitely not as much as the Bitcoin one, but still increases across the board. No increase for YTSL yet. I think that's going to be, my guess is that they're waiting for Christmas to give us a Christmas present maybe, but they're still at 30 cents a month, and the stock price is almost at $30. And we know that when the stock price was 29.30, the monthly dividend was kicked up to 40. So I wouldn't be surprised if they increase the distribution in December when they declared mid-December. I'm thinking maybe 35 cents, but hey, maybe we'll get an extra Christmas gift and it'll go straight to 40 cents. That would be great. Obviously, Tesla has been doing awesome because, Elon Musk is now very chummy with the next president of the United States. So as far as the other yield shares and as far as the Harvest income shares, well, Harvest, there's no distribution increases to speak of. We know Harvest typically sets a monthly distribution for a really long time, but as far as I've checked, the other yield shares, there's been no news. So that's it for the overview of the niche funds, the leveraged, non-leveraged, overall funds. What sectors are undervalued in my opinion? Well, listen, the markets are at all-time highs right now. The sector that's really lagging seems to be REITs to me, seems to be real estate, especially on the Canadian side. So of course you have MREL, which is the classic, just regular ETF, which invests in high quality REITs in Canada, is a good pickup for sure. I don't know why REITs are lagging, but every dog has its day. That's what I feel. Obviously, you guys know I'm a big fan of the Real Estate Split Corp, which has a lot of the same REITs as MREL, by the way. It makes sense because it's the same manager. But it's a split fund, so it has leverage, and now it's only at about 5% premium. So I feel like if you're really trying to capitalize on something right now, you're trying to find something undervalued in a record market, it's very hard. But there's always something. There's always something, guys. You just have to look. In my opinion, real estate and utilities are definitely the number one thing here. So you have MREL if you don't want the leverage, RS if you are okay with the leverage and you understand split funds. You have RMAX from Hamilton ETFs. This is REITs with covered calls, right? Covered calls, at the money calls on 30% of the portfolio. What's cool about this one is you have Canadian and American REITs, whereas MREL and RS really focusing on Canadian REITs. Another thing is that RS just completed their merger, so I'm expecting the holdings to be updated soon with a little bit more in the US. Maybe that'll help recover it a little bit. And last but not least, there's also HGR from Harvest. They also have a REIT covered call ETF, but it focuses more on US and things outside of Canada, REITs outside of Canada. So 4 great options here. If you want the pure growth, MREL or RS. If you want the covered calls, you got RMAX and HGR. Utilities, I feel, are also undervalued, especially Canadian utilities. Those telecoms are really not doing well now, especially Bell. So this could be a good time to pick up something like Utes from Evolve, which I just did a Q&A with Raj. Very, very high yield. We're talking 16%, 16.5% yield or something like that, maybe even higher. And it has electricity, telecom, and pipelines as well. So it's very high yield right now. Good pickup. UMAX as well. There's UMAX from Hamilton, right? This one has even the railroads as well. So it could be good diversification. Electricity, railroad, it has waste connections, pipelines, things like that. Really popular too, 510 million. The distribution's been going up a little bit, steady. So I think definitely REITs, real estate, and utilities are undervalued. We know that interest rates are supposed to be coming down, which helps a lot these sectors. It also helps financials as well, but Canadian financials, even American financials, have gone up so much. I can't really say they're undervalued as much as REITs and utilities, but again, that's just my opinion on what I feel is undervalued right now. So don't forget, guys, I know markets are at all-time highs, but don't forget that the markets go up over time anyway. So the best time to buy is always as soon as possible. So I put my money where my mouth is. You'll see that this month I made a lot of buys. And I'm just going to keep adding to my core positions. Even if they're going up and the yield is lower, it's still good to buy stocks and equities for the long term. That's just my opinion. So hopefully I didn't forget anything. Thanks so much for watching, guys. I really appreciate it. Hit that thumbs up button. I would really appreciate it. And we're going to do this again next month. Keep you up to speed on everything that's going on in the income landscape on the Canadian stock market. Take care, everyone. See you next time.